Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel, continuing on to part 2 of our leverage analysis problem. Get ready, it's time to take your chance with corporate finance. In this presentation, we're going to continue on with our practice problem. We have our information on the left-hand side. We're putting that into the blue area on the right-hand side. We started off with our first scenario, and we broke out our two focused plans here. Then we're going to go to scenario 2. Let's just recap what we have seen in the past. We started off with the assets. We had the assets at the 12 million, breaking them out between liabilities and equity. Liabilities at the 600,000, equity at the 600,000. That's your accounting equation. Assets equal liabilities plus equity. The debt financed at the 11.5%, par value on the stock $9. We had two scenarios for taking action in the future. One being, let's take a look. One being debt focused, the other being equity focused. We had a return on assets before interest and taxes of 11.5%, tax rate 30%. Then we had our two plans. We have the debt focused plan, which was we're going to take out a loan for the $2,980,000. The current rate was 12% in order to do so. And then we're going to use that money in order to buy back as many stocks as we can to increase the leverage basically on the debt side versus the equity side of financing the assets. Therefore, we bought back 331,111 stock. Or option 2, equity focused. We then issue stock 331,111 at the $9. Take that money and then pay off the debt, meaning we end up with more shares outstanding, more financing through equity and less through debt. This was our first scenario. When we took a look at it, we had the same earnings per share number from the current scenario, our starting point, as with the equity, due to the fact that we had the same rate here for the original debt that was taken out, as well as the return on assets before interest and taxes. And due to the fact that the interest went up on the debt, we ended up with a lower amount with the earnings per share. So now let's take a look at another scenario where we're going to say, let's calculate the earnings per share if the return on assets before interest and taxes was 5.75%, 5.75% here. So we're going to say, all right, 5.75%. Let's pick up our earnings before taxes. Earnings before taxes are then going to be, we're going to be picking up the 12 million. So I'm going to say this is going to be equal to the 12 million. And then I'm going to multiply that times the 5.75. There's the 690. That's going to be the same for our debt-focused plan and our equity-focused plan. Then we're going to calculate the interest on that. So where we originally started, if we were to calculate the interest, we would be saying, all right, now we've got this 6 million still on the debt, and the interest was that 11.5, and underlining here, home tab font group underline. That's going to give us, I'll just do that equals sign here. Let's do it this way. Equals earnings before taxes. Subtracting those two out, that brings us down to 0 right there. Therefore, the taxes are going to be 0 as well, because that's going to be this number times the tax rate, which is 30%. So that's going to be 0. Home tab font group underline. And then the earnings after taxes. Earnings after taxes are going to be 0, because 0 minus 0 is 0. And then if we think about our common stock that are going to be outstanding, we're going to say that's the same as it was before, the 666,667. And the earnings per share then is going to be, of course, 0. So that's going to be equal, the 0 divided by this is 0. Okay, so then what if we do the debt plan in this format? No, so notice same kind of thing for the debt plan as we did in the first scenario. We're going to say, okay, now we're going to have the beginning debt is going to give us the interest of the 690 that we had before. Then we're issuing that new debt, the 2,980, at the rate of 12%. So we're going to be picking up the same interest on the debt, which is going to now be at the 1,047,600. Underlining here, home tab font group and underline. If we then subtract these out, now we've got the 690 minus the 1,047,600. Now we have a loss. So and now we have a loss because, you know, we could see that the debt interest rate was at the 12%, but we have a kind of a declining scenario here where we're not in an increasing position, we're in a decreasing position. The return on assets went down, and as we know, when you leverage something with debt, that could result in the decline being escalated, kind of a multiplier effect on the downswing. So then if we were to calculate the taxes on that, we're going to say the 357.6 times the 30%. We have negative taxes. What does that mean? Does that mean the IRS is going to give us money? Home tab, font group. And then we're going to say no, but we might be able to carry that loss back or forward. And in so doing, we'll be able to offset income in the past or in the future. Therefore, it is kind of like they're not going to give us the money now, but we might be able to get the money by carrying it back to a period where we had profits, either backwards or forwards. That's what this little thing is saying right here. So we're gonna then say that this is going to be equal to the 357 minus the 250, and that's going to give us then the 250,320 of a loss. So again, notice the negative taxes kind of reduced the amount of the loss because we're assuming we're going to get a benefit from it in terms of a carry back or carry forward. Okay, so then if we take a look at the number of shares, we use that number to pay off the shares. So you'll recall that we did this calculation up top. We had the prior shares, and then we paid off, and then we bought back the 331,111 shares. So we can do that calculation here. This is the number of shares we had before, which was the 66,667 minus what we're going to buy back with this money we got from the loan. And so now we're at the same scenario we had up here. And then we're going to divide this out. This is going to be the 250,320 divided by the number of shares. Let's add some decimals, home tab, numbers, adding a few decimals here. We could keep going. We're going to stop at 2. So the 75 at the loss now. Now let's look at the next scenario. So the next scenario, we're going to be saying that we have the interest. So the next scenario, same kind of thing that we saw in the prior problem. We had the beginning balance, then we paid off some of the interest because we issued stock for scenario 2, meaning we issued the stock at the 331 at the $9 that we issued it for. We used that to then pay off the debt. So we used that to pay off the debt. So this is what the debt was. We paid off this amount of it. This is the new debt at that 11.5%. So the amount of interest now has gone down because we're financing with equity as opposed to the debt. And that's going to give us the 347.3. Let's put an underline here, go into the home tab font group and underline. Let's subtract this out. This is going to be equal to earnings before interest and taxes minus the interest. Then we'll calculate the tax, which is going to be this 342.7 times the tax rate of 30%. And then we're going to put an underline here. So home tab, font group, underline, subtracting, whoop, that was italicizing, that's not an underline, that's an italicize. And then we'll subtract these two, the 342.7 minus the 102.810 gives us the 239.890. Now we know that the number of shares have now gone up, though, because we issued the 331 shares, just like we did up top. So we had before that we had this number, and then we issued another 331. So we'll do the same thing here. I'm going to say this is going to be equal to the shares we had before, plus we issued another 331,111. So now we have a whole lot more shares outstanding, but we have a higher equity, a higher earnings before taxes, because we don't have that interest we're dealing with as an expense. So if we divide this out and then add decimals, we're at the home tab, numbers, adding a few decimals. We could keep going. I'm going to stop it at 2. So notice as your earnings go down, so as our returns go down, the debt focused plan looks worse here because that's going to, and you can think when you have more leverage, more debt focus, when there's a decline, that could escalate, the decline, and the equity focused plan looks better as we had this decline happening. So now let's think about the other type of scenario. Let's think, well, what if calculate the earnings per share if the return on assets before interest and taxes was 15%? So let's say that this earnings before interest and taxes now goes up, and what will happen then? So let's do this again. We're going to say, all right, we're going to start off with the earnings before interest and taxes. And now we're going to say that we have then the assets of the 12 million times the return now of 15%. And so then I'm going to say that's going to be the same for the debt and the equity. So now let's take into consideration the changes that we have here. We're going to say, all right, now the interest is still going to be, for the current scenario, is just going to be that 6 million times the 11.5. Let's put the underline here, home tab, font group, underline. That's going to give us our earnings before taxes. Earnings before taxes now being equal to 1,008,000 minus the 960. And then we're going to pick up the taxes. Taxes then equal to the 1,110,000 times the 30%. The 30% tax rate. Let's put an underline there. Home tab, font group, and underline. That's going to give us then our earnings after the taxes. Earnings after the taxes being the 1,110,000 minus the 777. That minus the 333, giving us 777. And then we're going to have the common shares that we have, which is going to be the same that we saw before in our prior scenario. That's 666,667. And then our earnings per share then now at the 777 divided by the number of shares. Let's add some decimals. Home tab, numbers, add a couple decimals. So now, of course, we have a higher starting point than we started from before. So 1.17. And then if we go to the next scenario, we're going to be saying that the debt, the interest area. So we're going to say we took out more debt now, and then we bought back the shares of stock with it. So it's going to be the same interest calculation. This is going to be the same calculation we did up top because now we have the new debt. And so we have the added or higher interest amount, same amount we had in the prior scenario. Let's put an underline, home tab, font group, underline. Let's subtract these out. This being the earnings before interest and taxes minus the interest. Then the taxes are going to be that 752.4 times the 30%. Let's underline that. Home tab, font group, underline. Subtracting these out, the 752.4 minus the 225, 720 gives us the 526,680. Then we're going to say the number of shares now, and this is the same thing we did before. Number of shares, what we had before, which is this number, minus the shares that we bought back with the money that we got when we took out the loan. So that's going to be equal to the number of shares that were out before, and then minus the shares that we bought back. And so that's the number of shares we have then. So now we're going to take this number divided by, so the earnings after taxes divided by the common shares, add some decimals, home tab, numbers group, add a few decimals. We could keep going. We're stopping at 2. So now we have the 1.57. Let's do the equity scenario. That's going to be the one where we issue more stock and then pay off the debt with the funds we get from the issuance of the stock. So if we were to say that, we're going to say, all right, well, that's going to be the same thing we did up top. And we have our worksheet on the right-hand side once again. So we had the beginning debt, then we issued stock, got money, paid off some of the debt, bringing the debt down, and then we have our interest rate at the 11.5. So we're then going to say, all right, let's say we pick up that amount, same amount we had before. Let's get rid of that blue line, put an underline here, home tab, font group, underline. Let's subtract this out. This equals the earnings before interest and taxes minus the interest. Calculate the tax. This equals the amount times the tax rate, which is going to be the 30%. Let's put an underline here, home tab, font group, underline. Let's subtract those two out now. Earnings before taxes minus the taxes. There's the earnings after the taxes. Then how many shares do we have outstanding? Same as we had before here, because you'll recall that we had this number of shares and then we issued this number of shares to get the money to pay off the debt. So we're then going to say, all right, this is what the shares were before plus this number of shares. Now we have this greater number of shares issued. This will be the earnings after taxes divided by the higher number of shares now, adding some decimals, home tab, number group, adding some decimals. So in this scenario, the debt financing plan looks better here, as you would expect here, because this is a period of increasing returns, and if that's the case, the more leveraged firm could end up. That's when you end up where it's possibly having that multiplier type of effect. Now, again, this is also more risky, however, because the debt, is quite high now. So you got to measure the risk of the added debt versus the possible gains. But you can see the kind of what will happen here with the multiplier effect that could possibly take place on the debt side of things, looking nicer if you could predict accurately into the future, when you're going to have the positive increase. And then you can see when the debt focus looks less attractive, of course, when you have the decline happening.